going to be edified by Michael Cow of www.urbancowboy.com, and that's Cow, K-A-O, not C-O-W. And Michael, I want to thank you, first of all, for granting the interview and coming back to have a conversation with me. There's certainly a lot to talk about, but I wanted to start with yesterday's news and the stress tests. Any view on, what the comments were that most of our banks are in good shape to handle almost anything that's thrown their way? Do you feel comfortable with that?
I actually do think that that's the case, at least for like the systemically important banks. But what is interesting over the last several years is you've seen this crowding out effect of essentially what was a traditionally bank-only role of making loans and warehousing credit risk. And you've seen that sloughed off to the shadow banking sector, right? And there's some good and there's some bad to come of that, right? And we can talk a little bit. I've been doing a lot of research on CLOs. I think CLOs are, for instance, a very robust structure that is effectively a better bank, a much better model than a bank. But then there's also been this proliferation of private credit, which is really totally unregulated, and you just don't. And the opacity and the fact that market, those loans are not traded or marked to market, that makes me nervous.
Okay, is that buy now, pay later type of loans?
Are you talking about like PIK?
Yeah.
I mean, there's a proliferation of PIK, which is payment in kind, right? Which is, if you think about it, that's the ultimate expression of extend and pretend and kicking the can down the road. And you've seen that happen over the years in the leveraged loan space as well. So a couple of months ago, I wrote a piece called "The Ostrich Effect," which it basically talks about how there's a lot of financial advisors out there that have been blindly recommending their clients to go into private credit because of the great Sharpe ratios and the lack of vol. But that's a very idiotic take, in my opinion, because the vol is zero because these securities are level 3 assets that just don't trade and have no vol. And as a smart friend of mine put it once, these represent kind of like a jump to default short put exposure, right? By the time the mark deviates from par, usually there's a negative crystallization event that's like triggered by like a default. That's why hence jump to default short put. So that is the ostrich effect. I call it the ostrich effect because these financial advisors are willingly or maybe unknowingly burying their head in the proverbial hole and be completely oblivious of risks that might be right around the corner.
Yeah, they're probably focused on the commission payout on a product like that, huh, Michael?
Yeah, I mean, so if you think about leveraged finance, it's about a $5.5 trillion market in the US. And it's broken up into 3 different segments. I call it the leveraged credit trifecta. There's 1.4 trillion of high yield outstanding. There's also 1.4 trillion of leveraged loans outstanding. But the new entrant, which has grown by far the fastest, is about 1.6 to 1.7 trillion of private credit. Now, high yield bonds and leveraged loans, they all trade publicly, right? And CLOs, the topic of my latest piece, which I called the Rumpelstiltskin risks of bad securitizations, talks about how there's also a lot of misinformation in the market that just because CDOs, another type of securitization, or mortgage-backed securities, both of these blew up in the great financial crisis, and therefore CLOs, which is the most popular form of securitization these days, by association in name, CLOs must be bad. But the truth is that CLOs use as their feedstock, the securitization feedstock, a very broadly diversified category of leverage loans, right? That's one segment of this leverage credit trifecta I talked about. And it represents very broad exposure to corporate America, right? That's very, very different than if you securitize, for instance, subprime mortgages or commercial real estate, right? Because those sectors are very, very narrowly defined. And if the shit, hits the fan in those sectors, even Rumpelstiltskin cannot spin, single B straw.
Can't turn that yarn into gold.
Into AAA gold. Yeah, that's
for
right.
people who don't understand the analog you're using, Rumpelstiltskin, a folk tale, a fairy tale about a man who could spin yarn into gold, and that's what they're doing with some of these CLOs. So
and so in private credit, to answer your question about stress tests, right? So I think the banks are in better shape,
but shadow banking.
But the actual banks are in better shape, but because of all these different regulatory requirements that have been imposed on them, that money has been pushed out into shadow banking. Some of it is in very resilient structures like CLOs that use broadly syndicated loans as their feedstock. But then there's a whole section of shadow banking, which is in private credit, that is not tradable, not mark to market, and unregulated. So,
okay, what makes that type of debt high risk is that it's been reported that the average American family pays more into non-mortgage debt interests than they do into mortgage debt interests, with their balance sheets already stressed by what's happening with credit and people maxing out their cards now. So is a slowdown really going to be an enemy where we're going to see that the emperor has no clothes in these products?
Well, that risk still lies mainly with the banks, I would say, right? Like credit cards. I'm talking about more institutional credit risks, right? So it just depends on. So like one thing, I made an allocation this week, because of my role now, my transition from being an active hedge fund manager to a family office investor. I now allocate to outside managers and strategies that are totally orthogonal to mine. And one strategy I allocated to this week, which I think is very interesting, is a continuation vehicle strategy in private equity that looks to. So private equity, you probably know, has had a dearth of exits and distributions over the last year or so, right? So the big LPs in these private equity funds are big insurance companies, pensions, et cetera, and they've got capital call obligations elsewhere. And so what happens is that there's a huge swath of private equity funds that are coming up to their 10-year anniversary in terms of vintage. And they have these trapped assets that are in their fund that are marked at perhaps unrealistic prices that they cannot sell and they can no longer earn fees on. And so there is an inherent arbitrage opportunity where, for instance, this continuation vehicle that I'm investing in is looking to break this logjam by incentivizing these private equity funds to let go of these assets at big discounts but in exchange for getting them cut back in on some carry opportunity, right? And so this theme though means that there are potential, because of this dearth of private equity distributions, you're starting to see liquidity in general dry up on the institutional side of things. And so I don't know what types of triggers could cause a broader sort of credit stress, but it could be anything from that, right? Liquidity, institutional liquidity drying up, to even something like what happened recently in France, where the big conservative sweep across Europe has caused a big divergence and a loss of confidence in French sovereign bonds. And so you saw like the spread between the French sovereign bond and the Bund blow way out. And to me, that just signals a potential every man for himself dynamic among central banks. So this introduces a whole new risk, a macro risk dimension. So these are all big macro trends that I'm A, looking to hedge against, or B, looking to benefit from, like in the case of the continuation vehicles.
Okay. Well, Michael, you're like the Oppenheimer of market analysis. When I read your stuff, it's almost like quantum stuff, and I feel like Forrest Gump when I'm talking to you sometimes and doing the interview. But I could wrap my head around when you're talking about sovereign debt problems and every man being for himself. So it's expressed a lot in currencies, and you talk a lot about the dollar wrecking ball. And technically, we're on the verge of a major breakout in the dollar, not that much higher from where we are now. And I'm wondering, is there anything that can, if it's every man for himself, you would think that perhaps the Fed would not want to see the dollar wrecking ball can really start swinging and knocking down and imploding the system. Can you come up with a narrative that the dollar wrecking ball could be put on hold for a while and we might have some dollar weakness that could be a reason for markets continuing to levitate, because a strong dollar is a headwind and a weaker dollar would be a tailwind?
Yeah, I mean, look, I think inflation is at the heart of this whole dynamic, right? Because what's driving the strong dollar, I've been saying for a long time now, like the bout of strong dollar that we saw in 2022 was when the Fed out-hawked the rest of the world. But I've been saying now that US dollar wrecking ball 2.0, which we're in the midst of, is coming from the rest of the world outdoving the Fed. And you've seen central bank after central bank, including the ECB, start to buckle and throw in the towel. But with the US, right, we have this issue where the amount of fiscal spend is swamping. This is my vodka Red Bull analogy that I keep talking about, right? The fiscal. The fiscal Red Bull is swamping the monetary depressant, and that bodes ill for most of the central banks around the world, because they can't keep up. The pace of transmission of monetary policy cannot be matched with what the Fed is doing here, right? So you're seeing central bank after central bank buckle. But the problem is that, as we saw this past week, Canada was one of those central banks to buckle. Right. But then as soon as they buckled, they saw a resurgence of inflation numbers, right? And so that is a very, very cautionary tale. I do think that we are in a stagflationary backdrop, and hence my every man for himself dynamic on the macro side of things is that is inflation is at the crux of that, right? Because if you go all the way back to the Plaza Accords of 1985, what caused that to happen? Well, first of all, let's just put it into context. The
We had a crashing
DXY,
bond market
well, the DXY
and
though,
dollar.
the DXY had reached 165 versus 105 right now. And people are already belly aching about, the strong dollar. But interest rates back then were like 8% by the time, by the way, the Plaza Accords only came about because it behooved the US finally to do so. The US basically had to essentially call a group of nations together and said, hey, look, the dollar is way too strong. I don't think we're there yet, because I think that when you talk about what behooves the Fed to have a weaker dollar and have a essentially an easier monetary policy, it's when they feel confident that inflation is licked. And until they feel confident that inflation is licked, I think that it's kind of every man for himself. And so, yeah. So
well,
I think that's the problem.
Who really runs this market? Is it the Fed that pushed back at their last meeting on a good inflation report? Because I'm looking at the 10-year right here, Michael, and a series of lower highs. And this 420 level in the 10-year looks very pivotal to me. Yep. And should we take out 420, you could take 54 bips underneath it, takes it under 4 to about 370. Would that be enough to stave off a dollar wrecking ball because rates are relative? Is it now in our interest for rates to drop?
Are you saying? I'm sorry, rephrase the question. Are you saying that are higher rates enough to stave off the dollar wrecking ball?
No, this I'm talking about. This is a 10-year yield. So if we take out 420, we're going to 360.
Oh, on the downside.
Yeah. So I mean, and the bond market has been pretty well behaved, and actually it has a nice pattern. I think the trend has changed. At least for a huge bear market rally in bonds. Here's a big picture. I think that we could take out the par level. This is a nice looking month and quarter where we might even be able to trade up to, 119, which is only a bear market rally, right, Mike? I mean, we crashed.
I'm not seeing it. I actually have the opposite view on this. Okay. Yeah. I'm not really seeing it.
That's fine.
I mean, I think that the cautionary tale I'll say about the long end of the curve is that when you look at the analog of, call it 78 to 81, I keep saying this, like from 78, 79 to 80, you had very high inflation, you had a very, very aggressive Fed, jacking up the front end. And then with each successive hiking phase, you then saw, after a couple of months, you saw some bear steepening on the long end as it would adjust to the higher front end. But then the real steepening came by the end of 1980. I guess the U.S. economy was already in recession, and then the Fed basically cut and dropped the front end quite drastically. And then you saw a massive bull steepener where the long end of the market just basically said, you know what, we don't think you've licked the inflation problem, and so now we're going to do your job for you. And so that's when you saw long end rates really blow out. So I think the bond market right now, this bear market rally that we're both talking about, is exactly that. It is rallying based upon this. I think it's a Pavlovian reflex over the last 30 years that every single time we see some sort of economic slowing, the Fed can jump in and cut rates with no deleterious inflation consequences. But as what Bank of Canada just showed, it probably will have inflation resurge. And it's not just Bank of Canada. It's basically what the Fed did to itself with the rhetorical pivot. I mean, just words in December,
Yeah.
waxing dovish in that
Got the
December
animal
presser.
spirits going. Yeah.
100%. Yeah. So
Yeah.
so I think that is the risk here, Dale. I think
Okay.
that if the Fed, and this time the latest FOMC presser was interestingly more hawkish than people expected, despite an actual slowing of economic data, because I think that they're very concerned about loosing the animal spirits again. And so I think the bond market will rebel and yields go higher if they cut early or wax dovish again.
Okay. I'm just a technical trader that thinks the economy might be weakening enough to have something like this from here, which under 420 will be an additional signal for me. But, I want to talk about every man for himself. Japan needs some help, and intervention isn't really helping the yen yet. So for every man for himself, and the Japanese consumer is starting to get a little bit angry about their currency losing purchasing power. You have any view on what the BOJ may do to stem? I mean, here's an example of the dollar wrecking ball, right? Playing
That's
havoc
right.
in Japan.
And it's
Would it
far
be
worse
in our
EMs.
interest, the
Yeah.
Fed's interest, to help them out and coordinate something with them?
Well, look, I think the reason why our allies have FX swap lines is to help them when if there's a real need, but there's a limit to how much help that can a swap line can do. Like, I think of a swap line as essentially a collateralized short-term loan. And so if the Bank of Japan taps its swap lines with the Fed, it's expensive, right? They have to pay interest on that loan, and B, they have to pay it back. And so in 2022, right? I think there was some coordinated intervention. That was when the dollar yen first made its approach to 150. And it basically,
it was verbal, though, wasn't it? Just verbal?
Well, the thing is, I had heard that it wasn't verbal. I had heard that
was here.
There was some surreptitious intervention where it's a coordinated intervention. It's hard to prove that, right? But when that happened, you saw 10-year yields go way down as a result of that. And then look what happened to us, right? It certainly didn't help our own inflation issue. And the other issue is that, we ideally want to help somebody who's helping themselves, right? I wrote a piece a couple of months ago, you may remember, called The Battle of the Bads, where I kind of walked through the decision-making matrix for each of the central banks. And pretty much in every single case, and maybe perhaps, and most especially for the Bank of Japan, the less bad choice is to let the currency depreciate, because the other choice is far worse. The other choice being letting JGB yields go to a market-determined rate. They say that there's no rate cap, but that's complete bullshit, right? If there was no rate cap and JGBs traded to a market-determined yield, it would completely implode all of their financial institutions. Oh, yeah. I mean, who knows? 3+%, right? 3+%, 4%. I mean, who knows, right? So I think they are in a very, very tough spot. And as a result, it puts China in a very, very tough spot. I think China is the big kahuna. I've been short, the yuan for over a year now
Okay.
on that premise. So
Okay. Uh, Interesting. In China, there have been talk they're going to let it go. They may just let it go. They tried to manage it, but they spent a lot on intervention. And you have targets in the yuan, or it's
well,
just
I think if they I don't know if they can let it go without really imploding their own economy. But so what China has is that they have a closed capital account, and so they've been I guess the way they've tried to manage this depreciation is to slowly move their CNY fix out a little bit each time. But I don't know if you listened to this on my podcast, Chaos Theory. The last guest I had was this gentleman, Brian McCarthy, who spent some time in China and ran a short yuan thesis way back in since 2015, 2016. And his theory is that China really cannot do a managed depreciation for that much longer. And I think the stress is building underneath. See, most people think that the PBOC has this pristine balance sheet, and people point out that they recently sold long bonds at like a very low yield. I think it was like a 2-something yield or something like that. But it's a complete farce of a market. It's a completely bogus market, because underneath that veneer, you've got this metastasis in the LGFVs that make the U.S. debt to GDP on a consolidated basis look like nothing. So I think China has some real problems.
China's your biggest worry. Let me ask you,
yeah,
in 2008, during the Great Recession, I don't know if it was great for you, but that's what they call it. Wasn't that great for me? China's strength at that time, relative strength, helped pull the world out of the mire and the recession. So I'd like to know if China's weakness and possible problems and deflationary issues with makes our real estate CREs look like pristine, can drag us into a global recession. Could China, if they can
for
help us
sure.
on the upside, do you think
Oh,
that's going to?
absolutely, right? Because one mechanism, see, the dollar wrecking ball ultimately is a equilibrating mechanism, right? It's basically exporting our inflation and importing deflation from without. And the biggest source of potential short-term deflation, in my opinion, is from China, right?
Okay.
And if they devalue, right, if they really let the yuan go, I could see it depreciating by 50% easily, and that would be very, very deflationary.
That would take it to 10.
Yeah.
To 10.
Yeah.
Okay.
Yeah.
All right. So, Michael, very interesting. You stick to your guns. Well, all cowboys stick to their guns, right? All right.
Right.
And, I hope you didn't mind that. To me, when I read your stuff, sometimes I feel like Forrest Gump, simple, stupid, and but I spend the time thinking about what you say. And I believe that, I believe that people should take the time to understand a lot of the themes that you talk about, because they're not talked about by the average market analyst, market watcher, and encourage people to continue to learn because they're either growing or dying. And
thanks for having me.
Yeah, I think
Appreciate the
you're
opportunity.
a great piece of intelligence gathering for anyone who's watching now or hears it later. Thank you,
Awesome.
Michael Cow.
Thank you so much. Thanks,
All right,
Dale.
everyone, follow Mike. Follow him on X at Urban Cowboy. go to his website. I just showed it here, and you could just test the waters by getting his free stuff before you go the paywall, and you'll see what I'm talking about. All right. Thank you,
Thank you.
Michael. Good
Take
hunting, my
care.
trading warrior brother. Adios.
Adios.